Gold just officially replaced US Treasuries as the world's #1 reserve asset. Let that sit for a moment. The thing that an editorial in the Financial Times called a useless relic back in 2004, when gold was trading at $400 an ounce, has now overtaken US government bonds as the most held reserve asset on planet Earth. And here's the part mainstream financial media will not connect for you. Three very different analysts, a precious metals dealer, an economist, and an independent macro commentator, are all arriving at the same conclusion right now from completely different directions. And when that happens, you pay attention. Today, I'm going to break down exactly what is happening, what it means for your money, and what the smart money is already doing while most people are still distracted by noise. Let's start with what just happened because it is genuinely historic. The European Central Bank just published a report confirming that gold now accounts for 27% of all global central bank reserve assets. US Treasuries, down to 22%. Flip that around in your head. For decades, we were told treasuries were the bedrock of the global financial system. Safe, reliable, the world's go-to asset. Now gold has passed them. And this did not happen because of one country or one crisis. Central banks have been buying gold at more than 1,000 tons per year for 3 straight years. Even in 2025, when that pace slowed slightly to 850 tons, it was still nearly double what was normal before 2022. China, Poland, Turkey, India, all aggressively adding to their reserves. And here's the part most people miss. Independent analysts believe even these numbers are underreported. Central banks don't always tell the World Gold Council what they're actually doing. There's a commentator who actually laminated a 2004 Financial Times editorial that said gold was pointless, back when it was $400 an ounce. Today, that same publication is reporting gold has replaced treasuries as the top reserve asset. That is not irony. That is a 20-year lesson in why you don't listen to consensus when the math says otherwise. Now, here's where I want to push back on the way most people frame this story. You'll hear de-dollarization everywhere, the idea that countries are running away from the dollar. And while that's partially true, it misses the deeper thing that's actually happening. The real shift is a collapse in trust, not just trust in the dollar, trust in the entire system the dollar represents. Think about what happened in 2022. The West froze Russia's foreign reserves, hundreds of billions of dollars, and kicked them out of SWIFT. Every country on earth watched that happen and quietly asked, could that be us next? And the answer for many of them was yes. Because if you're on the wrong side of U.S. foreign policy, your money can be taken, your treasuries can be frozen, your access to global trade can be cut off overnight with a keystroke. And so countries started doing something very logical. They stopped trusting a system where someone else holds the keys. Germany repatriated its gold. Then Austria, Hungary, Turkey, Poland, the Czech Republic, they all brought their gold home from the New York Federal Reserve and the Bank of England. India recently pulled almost all of its gold back from the Bank of England. These countries are choosing physical control over convenient access. They're saying, we'll give up the ease of trading on Western exchanges rather than risk losing everything we've worked for to a sanction we never saw coming. That is not a radical fringe view. That is now official policy for multiple NATO members. The head of the Polish National Bank said publicly that Poland holds gold because, and I'm paraphrasing closely, if someone pulls the plug on a global financial system that runs on electronic accounting records, gold is what keeps the country standing. A NATO central banker is openly preparing for the lights going out on the global financial grid. When that's not a conspiracy theory anymore, it's policy. You need to update your thinking. Now let's talk about the thing that is quietly driving all of this. And it has nothing to do with gold or silver directly. It has to do with U.S. debt. The national debt is approaching $40 trillion. That alone is not the scary number. The scary number is this. 1/3 of that debt matures within the next year. That is $12 to $13 trillion that needs to be refinanced, borrowed again, right now at today's interest rates. On top of that, the U.S. needs to borrow another $3 trillion just to cover this year's deficit. That's potentially close to $16 to $20 trillion the U.S. government needs to raise in the next 12 months. To put that in perspective, the last time U.S. Treasury yields were this high, back in the 1990s, the entire national debt was about $4 trillion. Today, it's 10 times that. The math does not work the same way it used to. And here's the trap the Federal Reserve is stuck in right now. If they cut short-term interest rates to relieve pressure on the government's refinancing costs, it spooks the bond market because investors read a rate cut as more inflation coming and long-term yields go up. But if they keep rates high or raise them, then all that short-term debt that's maturing becomes even more expensive to roll over, and asset prices, stocks, real estate, start to crack. There is no clean exit from this. The only historical playbook that fits is money printing. Inflate the debt away. And if that's what happens, then the purchasing power of every dollar you hold gets quietly destroyed, while the nominal price of things you own looks fine on paper. That is exactly the environment where gold performs, not because it's shiny, because it cannot be printed. Here's the thing that trips people up the most when they look at gold and silver right now. They watch the price and they get confused or discouraged. Gold sold off. Silver pulled back. Must not be the right time, right? Wrong. Price, in the Western paper markets, is a tool of misdirection. And here's the proof. At the beginning of this year, while silver prices were being absolutely crushed, the CME Group quietly raised margin requirements by 300% in a 6-week window. That means the cost of holding a silver position jumped from roughly $15,000 to $54,000 for the same contract. At the same time, leveraged ETFs had to rebalance. At the same time, primary dealers were required to take new mint allocations, 3 forces designed to generate selling, all hitting at once. Price collapsed. Retail investors panicked and sold. And then China came in and imported more silver in the first 90 days of this year than in any comparable period in the history of the country. India is estimated to have accumulated close to 900 million ounces of silver over the last 3 years, and 39 million ounces of physical silver were removed from COMEX warehouses in February alone, put on trucks, and driven away. Nobody on mainstream financial television has even asked who did that or where it went. Now the CME just slashed gold margins by 9% and silver margins by 11%. They're trying to bring liquidity back. The weak hands have been washed out. Open interest on COMEX is at a 30-year low. What that means is the people who were holding for the wrong reasons have left. What remains are the strong hands, and the next move up in this environment won't look like the last pullback. Let's talk about silver specifically, because the setup here is unlike anything I've seen discussed in mainstream finance. First, supply is getting quietly strangled. About 80% of mined silver comes as a byproduct of copper production. China has been restricting exports of sulfuric acid, which is critical for copper mining. Less copper production means less silver comes out of the ground. At the same time, silver demand from solar panels, semiconductors, and electric vehicles is exploding. The supply is tightening while industrial demand surges, and then you add monetary demand on top of that from central banks and sovereign buyers. Second, the gold-to-silver ratio is wildly out of historical alignment. Analysts at Bank of America have talked about silver potentially reaching between $130 and $390 an ounce this year, based purely on that ratio normalizing. Now, those are projections, not guarantees, but when the ratio is this stretched, the gap historically closes fast, and it closes violently on the silver side. Third, and this is the argument that Peter Schiff makes that I find genuinely compelling, tokenized gold may actually be the future of crypto, not Bitcoin. His logic is clean. Gold can do everything a stablecoin does, but better, because it also stores value. A tokenized dollar pays no interest and loses purchasing power over time. Tokenized gold holds value and can be transferred instantly. The argument isn't gold versus technology. The argument is that technology makes gold more useful, not obsolete. Mining stocks are also worth watching here. Some analysts are pointing to 5 to 20 times upside potential in quality mining companies because they're priced cheaply relative to the metal itself. That's a risk trade. But if you're already holding physical as your foundation, mining stocks can be the amplifier. Now I want to address something that a lot of people who hold physical gold and silver are quietly worried about, and they're right to think about it. The financial world is moving toward full digitization. The Genius Act in the US is essentially tokenizing the dollar through short-term Treasury-backed stable coins. Securities are being put on blockchain. Every major financial system is building toward instant digital settlement and clearing, and the pitch will be efficiency and transparency, which sounds great until you look at what transparency actually means for you. When Iran's Revolutionary Guard Corps had their crypto wallets frozen, the authorities didn't just block the wallet. They froze the smart contract at the protocol level. The funds became completely unusable across the entire system. The wallet holders didn't even know it had happened yet. That is what financial containment looks like in the digital age. Your money can be switched off, quietly, completely, without warning. Physical gold and silver held in your own possession has no smart contract. Nobody can freeze it remotely. That's not a political statement. That's a technical fact. The honest reality, though, is this. When you eventually want to sell and access those gains in dollars, you will re-enter the system. There will be capital gains taxes. There will be reporting requirements. The answer isn't to pretend you can live entirely outside the system forever. The answer is to hold real assets during the period when the system is most at risk of repricing against you, and re-enter when it's on your terms. Do everything the right way. Document it. Pay what's owed. But hold the asset that cannot be frozen while the chaos sorts itself out. So what is the single most important thing to watch right now? Across all three of these analysts, and they don't even always agree on everything, there is one thing they all point to: the yield on the 10-year US Treasury. The Federal Reserve controls the short end of the curve, but the 10-year is set by the market, and the market is a brutally honest judge of confidence. When bond investors start losing faith in America's ability to manage its debt, they demand more yield to hold that debt. When yield rises above 5%, we already saw what happened to Silicon Valley Bank at that level. Imagine what happens at 6, 7, or 8%, with a debt load 10 times larger than when rates were last that high in the 1990s. Everything, stocks, real estate, bank balance sheets, pension funds, is inversely correlated to rising long-term rates. All of it. Gold and silver sit on the other side of that equation. They don't go to zero when rates spike. They have no counterparty. Nobody owes you anything when you hold them, and nobody can take them from you. Now here's where I want to leave you, and I think this framing is important. This doesn't have to be a story of doom. There is a famous scene in Shawshank Redemption where the protagonist has to crawl through a tunnel of sewage to reach freedom on the other side. The mathematics of what America has built, the debt, the leverage, the distortions, means we are going to crawl through something difficult. That is not opinion, that is arithmetic. But on the other side of that, single-digit price-to-earnings ratios on blue-chip stocks, real estate at prices that reflect real interest rates, real opportunity for people who preserve their purchasing power through the chaos. Gold and silver are not just about surviving what's coming. They are about being positioned to thrive when it's over. Watch the 10-year. Watch the silver flows. Watch who is taking physical delivery every single month on COMEX and not telling anyone why. The big money is voting with its feet, and they've been voting the same way for 18 consecutive months. If you found this valuable, drop a comment right now. I want to know your answer to one question. Do you think silver is primarily a monetary metal or an industrial one in 2026? Because how you answer that changes everything about how you position. I read every comment. Share this if someone you know needs to hear it, and I'll see you in the next one.